Okay, so it's parent contingent, meaning you call your broker. This is how we did it back then. You call your broker and you say, okay, I want to buy Christmas bonds, which is December contract of 30-year Treasury bond, and at this price. Where's your stop? You want to use it outside? Do you want to use a stop? Yes. You tell them how many ticks away it was, okay? And I would use a 10-tick stop. So it's about $300 some per contract. And in the beginning, it was just one contract I was trading. So I would have no target. I would just wait. I wanted to see how price behaved. Sometimes it would fill me and then stop me out. And that would wreck my whole fucking day. I would be half-ass filling the machines because I was mad. I'm mad. So I'm just like you, okay? I'm just like you when your shit doesn't go right, you want to blow up. You want to show the world that you're pissed off. You don't want them to ask you what you did wrong, but you want them to understand you're pissed off. I'm having a bad fucking day. Don't talk to me. So I would be driving around all through Baltimore City and Baltimore County, filling up vending machines, pissed off that I couldn't see what it did. And then I would go home that evening, go through the process of doing my normal thing, work out, get all the stress out of me, take a shower. I've already ate. Now I'm looking at the charts and I could see these things start happening. Like, if I would have saw that on the chart, I could see how I wouldn't have bought there yet. I would have done this, I would have done that. And that sounds like, oh, it's hindsight 2020, but you know how I trade now. I can tell you honestly, if I would have done something, I've done it this year. I did it last year too, telling you. If I would have been trading, I would have got stopped out there if I would have done that trade. It's not a lot, but in the beginning, it was a lot. I did it wrong a lot with no encouragement like I'm giving it to you. So it's normal for you to feel like you're spinning your wheels in the beginning. It's going to be like that with whatever you do in trading because you're competing with yourself. You have an expectation of yourself, whether you want to admit it or not. You want to see yourself somewhere in the future, whatever that timeline is. You're presenting this as a goal for yourself, and you're manifesting that as your destination. When that destination is going to evolve so many fucking times over the next several years, what you think you're going to be satisfied with is going to change a lot, especially when you start finding consistency and profitability. That shit's going out the window. Forget about it. Like you're going to completely change how you think about yourself, how you're going to live, what you're going to do with money, how you're going to spend it. Like it's all going to change because you don't know what it's like to make 6 figures. You don't know what that feels like. You don't know what it feels like to make 7 figures. You don't have that. You don't know what that feels like. But you also don't know what it feels like to lose 7 figures. For some of you, that's the end of the fucking world. That's it. I'm never touching this market again. I'm never going to do it again. But that's a lesson that you're going to have to go through. You're going to have to go through the ups and downs of what you think you understand and what you really learn from going through it. That was the ICT model. That's what I was doing. And then I realized that there were some trades that were forming that would escape my observation. I wouldn't be able to anticipate them. And the things that led to me understanding more about that was comparing the 5-year, the 10-year, and the 30-year bonds. Comparing them while they were trending lower, I'm looking for an opportunity to go long. Well, I noticed that one of those yields would diverge. And I'm thinking to myself, every single time that this thing happens, there's some measure of an intermediate term price run that forms, and it gives me an opportunity to find a move. So I want to be able to study this and go back in time, and does it exist a lot? And I found out that that's in fact what was occurring. And now you know through core content, that's my bond, the triad, the divergence, the S&T divergence for the bonds. Like, if, for instance, say the stock market goes to shit, okay, or it stayed in a really choppy garbage range, I would just go over to bonds. Like, I can go back to where I started. That's my home, okay? I moved from bonds to trading S&P because I like the volatility that S&P would give intraday. Bonds were a lot smoother, a little bit more. Hang on one second. I'm in the Highlander. It's shut off because I've been sitting here. I need the air conditioner. It's a little too warm in here. But I moved from the bond market and started exploring the opportunities that the index futures were offering. And I would trade the stock market the same way I was doing the bonds. If I was bullish, I would allow for, the opening price, get that opening price. I'm already bullish, so I want to see it try to trade down below the opening price. So even if it's, going down a little bit, I don't care. 5 ticks above that opening price, I'm buying strength. And then if it was good, it would just run off. And if it was bad, it would stop me out, and then I'd be like anybody else, losing their freaking mind about it. Blaming myself and blaming everything else. I should have did this, I should have did that. And I hurt myself by doing all those things. And this is the reason why I teach all of you, when you're journaling, or if you're talking on social media about what you do and what you've done, you don't want to be negative, because you're reinforcing this whole idea about trying to be perfect. And perfect doesn't exist. I mean, it exists in Christ, but you're not going to be here. And you can't do that in trading. You're going to lose. Sorry for the folks that have headphones on. Got to move away. This dude just pulled up next to me. He's just like steady staring at me. I don't do autographs, bro. Get away. So, while I had a heavy required indicator-based strategy in the beginning, I obviously evolved away from all that stuff. And there's a way of using indicators, yes. But I don't think that a new trader should go there. They should learn primarily naked price action. And you'll develop your own tools, which is what I've done over the years, and things that you can apply to price, but not necessarily manipulate price. Like, I don't have anything that measures rate of change. Like, I don't use any kind of CCI. I don't use any kind of oversold, no stochastic, no RSI, none of those things. They're measuring rate of change. And whatever you're doing with those indicators and whatever input you're using, for instance, like I was using a 14-day, at some point it moved from 14 period to 10 period, and then 9 period, smoothed by 3-3 on a slow stochastic. That's what I had. And then I would use a 9 period Williams percent R. And I started noticing that sometimes the Williams percent R would give me the oversold condition that I was looking for, but the stochastic wouldn't. But it would start running off, and I'm like, what the hell just happened here? Like, it shouldn't have done that. It's supposed to listen to this indicator, for fuck's sake. Why is this doing that? I wasted years doing them, arguing why the market wasn't listening to this indicator. And that's what people do when they get in these indicators. They get pissed off, and you see them when they're YouTubers, they're live streaming. Just watch them, read their face. They're disgusted. Man, that's the trade that they got in, they didn't tell you about. Okay, that's it. That's the one that's burning them. Okay, but then they'll say, oh yeah, I took a trade here. I got long here. You didn't say you got it long then. You didn't do that. You did not do that. Okay, so there's a difference. I'm calling shit beforehand. I'm telling you where it's going to go. So don't be comparing me apples and orange bullshit. Okay, but you're going to get wrapped up in all this indicator pursuit and waste so much time doing that. When I first teach students, under my wing, the first thing you're doing is take everything off your charts. Take everything off your charts. Completely naked, open, high, low, close, or candlestick. That's it. Then you're going to study price in relationship to time. When do intraday moves occur? When do intra-week moves occur? Is there an influence that you can set a clock to, which is the economic calendar? All of that built into what you anticipate is going to happen on that weekly chart. Is the weekly chart most likely going to expand higher, or is it more likely to expand lower? That right there sets the tone for what you want to focus on going forward in the new week. Do you think that the market is really close to a target that you've been watching? If that's the case, that it might go up and expand to a premium level or a higher time frame resistance point, okay, something like that for folks that are brand new, don't know my terminology. Then you would anticipate some measure of potential intra-week reversal. But sticking with the narrative that it's not advised to try to pick tops. I don't try to pick tops, but it allows me to formulate a game plan that if I'm bullish, for instance, we were bullish on NASDAQ, and I took your attention to a very specific gap on the weekly chart, and hopefully I've dispelled all the confusion, because invariably people in my comment section, you can't see the comments in the new videos, but it's still a sugar coma, you know. It's all love basically, but the few people that are questioning, they're saying like, you know, why am I using the June contract and not the continuous contract? If you're looking for volume imbalances, you need to be using the contract month. Okay, that's a characteristic for that specific PDA rate, which is the reason why I get pissed off when people try to pretend they understand it.